I have this theory that the most dangerous place in the world for your bank account is your Instagram feed at about 11:30 at night.
That is a very, very specific time and place. Why then?
Because that's when the algorithm knows you're tired, you're aspirational, and you're just a little bit vulnerable. And that is when it hits you with the render. You know the one I'm talking about?
Oh, I do.
It's that glittering glass tower in, say, Dubai or Miami. There's a white Ferrari parked out front. A couple is laughing over an espresso on a balcony that seems to just float in the clouds. And then you get the hook. Own a piece of the future. Pay 1% a month.
Ah, yes, the lifestyle arbitrage pitch. It's incredibly powerful.
It is. And even though I think of myself as a rational person, there's this little part of my brain that just goes, wait, I don't need $1 million cash. I just need a few thousand a month and suddenly I'm a real estate mogul. It feels like a cheat code.
It's designed to feel that way.
But, and this is why we're here today, I've always had this nagging feeling that if it's this easy, who is actually paying for the party?
And that is exactly the right question to be asking. The answer, almost always, is you.
Right. So today we're stripping away all that glossy marketing. We're looking at a really dense, no-nonsense piece of research. It's titled The Off-Plan Illusion: Mastering UAE Real Estate Investment by Dr. Pooyan Ghamari. And let me tell you, this document is not trying to sell you a condo.
No, it's trying to stop you from losing your shirt.
Exactly. It's a cold bucket of water.
Yeah.
Dr. Ghamari's central idea is that what people call investing in off-plan real estate is, in many cases, actually a structured transfer of risk.
And that phrase right there is key.
It stopped me cold. Structured transfer of risk. It sounds like something from a derivatives trading desk, not a property brochure.
Because the mechanics are surprisingly similar. When you buy off-plan, meaning a property that doesn't exist yet, you are not buying an asset. You're buying a futures contract. You're buying a promise.
Surprise.
And the developer is using your capital to finance the build, which minimizes their equity exposure. So you are taking the market risk, the construction risk, the delivery risk. They're taking the profit.
So in plain English, I'm the bank.
Yes.
But I'm a bank that doesn't charge interest and takes all the risk if the whole thing goes sideways.
Essentially, yes. And the mission of this deep dive is really to move you from that lifestyle aspiration mindset, which is getting seduced by the render, to a professional allocation mindset. We have to look at the financial plumbing, not the infinity pool.
Okay, let's look at the plumbing. And I want to start with the price. Because the bedrock belief of every single off-plan buyer is phase one is the cheapest.
Right.
If I get in at the launch, I'm getting the ground floor price. If I wait, I pay more. But Ghamari says this is, well, he calls it a myth.
It is very often a myth. And to understand why, you have to understand something called absorption targets.
Absorption targets. That sounds like corporate speak for, what, sales goals?
It's a bit more technical. Developers don't price units based on fair market value or even construction costs plus a margin. They price them based on the funding model they need at that moment. They might need to sell, say, 30–40% of the units very quickly to satisfy their own lenders or to fund the initial work.
So the phase one price isn't a deal, it's a liquidity event for the developer.
Precisely. Phase one is priced to generate headlines. They need to manufacture scarcity. They need that press release that says, sold out in 4 hours. That creates the FOMO, the fear of missing out for all the later phases.
Okay, but let me play devil's advocate here. I have seen this happen. Phase one launches at 1.5 million. Phase two launches 6 months later at 1.6. So the phase one buyers did make money, right?
On paper, they did. The list price went up. But here's where the illusion kicks in. What happens if the market softens by the time phase three comes around? Or maybe the developer just needs to clear the last few units to move on to their next project. They can't just drop the price to 1.4 million.
No, the phase one buyers would riot. It would kill confidence in the whole project.
Exactly. So they keep the high list price, but they introduce hidden discounts. This is the architecture of pricing that the amateur investor misses. They'll start offering things like furniture packages worth $50K. They'll waive the 4% registration fees. They'll offer post-handover payment plans that are basically interest-free loans.
Ah, I see. So if I'm a phase three buyer, I might pay a higher sticker price, but when you factor in the free furniture, the waived fees, the time value of money on that payment plan,
your effective acquisition cost could actually be lower than the guy who camped out overnight for phase one.
that is wild. So the early adopter is really just subsidizing the marketing for the later buyers.
In many cases, yes.
Yeah.
And there's another layer here. By the time the building's actually finished, 3–4 years later, You are not just competing with the developer's unsold apartments.
You're competing with the secondary market, with
Mm.
ready properties right next door.
Ready properties which carry zero construction risk. And if you can buy a key-ready apartment in the building next door for the same price per square foot as the off-plan launch, the entire investment case just collapses. Why would you take 3 years of risk for absolutely no discount?
Because the payment plan makes it feel affordable.
Yeah.
And that leads us to the second trap in the source material. The payment plan itself, pays 60% during construction, 40% on handover. I always saw that as flexibility. I thought the developer was being nice to me.
It is framed that way. Marketing calls it affordability. But Dr. Ghamari defines these as control mechanisms, as cash flow instruments.
Cash flow instruments.
Think about the math. If you're on a 60-40 plan, you are effectively financing the construction. You're their working capital. The developer is minimizing their own cash injections.
So I'm minimizing their risk again.
Correct. And the danger is what the source calls speculative deployment.
Mm.
Let's say you're on a plan where you have to pay 70% over the first 2 years, but the project gets delayed and now won't be finished for another 2.
So I've sent them 70% of my money.
And you have zero asset. You can't live in it, you can't rent it, you can't leverage it. And here's the real kicker. If the market dips, you can't easily sell your position. Who wants to buy an unfinished contract in a falling market? You have maximum exposure with zero utility.
So how do we know if a plan is a trap? Is there a metric for this?
The source suggests something called the sophisticated buyer test. You reverse engineer the plan. You ask yourself, what percentage of the total capital is at risk before I can actually verify the construction quality?
Ooh, I like that. Before I can see if the windows are actually double glazed or if the lobby looks like a motel.
Exactly. If the plan requires you to pay more than, say, 50% before you can verify the physical reality of the asset, Ghamari argues that's not investment. That is gambling. You're just betting on the developer's execution.
Which brings us to the most critical variable in this whole thing. If the brochure is marketing and the payment plan is a funding trick, then the only thing that really matters is the execution, the developer track record.
This is the only reliable signal. But, and I want to really stress this, checking the track record does not mean looking at their website to see if they won Best Luxury Project 2024.
Yeah, those awards are mostly just bought, right?
A lot of the time, it's just marketing fluff. We need to look for delivery history under pressure. It's a brilliant distinction in the text. Anyone can build a tower when the economy is booming and materials are cheap. That doesn't prove anything.
You want to know how they performed when the world was on fire?
Precisely. Did they deliver on time, and I mean exactly on time, during the supply chain crisis? When steel prices spiked, did they finish the project? Or did they just stop construction and demand more money?
Or did they? They value engineer, that's the term, right? When they swap out the good stuff for the cheap stuff.
Value engineering is the silent killer of returns. The brochure showed Italian marble. The reality is ceramic tile. The brochure showed granite AC units. The reality is a generic system that breaks down every summer.
But how do you find the stuff out? They don't exactly advertise, hey, we decided to use cheaper elevators.
You have to do some forensic due diligence. You don't ask the sales agent. You go to the buildings they delivered 5 years ago. You walk into the lobby. You talk to the security guard. You check maintenance records.
Talk to the unhappy owners.
Yes. Go on the forums. Look for owners' association groups on Facebook. Ask them directly. How are the service charges? Are there leaks? How do they handle defects? Because behavior is a pattern. If a developer has a history of delivering 18 months late and ignoring claims, they are not going to suddenly change.
It's like dating. People show you who they are. You have to believe them the first time.
Exactly. Prioritizing renders over reality is the amateur's mistake.
Sure.
The pro looks at the scars on previous projects.
No, okay, so let's say we found a developer who isn't going to rob us. Now we have to pick the spot. And this is where the source distinguishes between districts and intersections. This felt very actionable to me.
It is. It's the difference between macro marketing and micro reality. Marketing sells districts. They sell the new downtown or the waterfront city. It's this vague, sweeping story about growth.
The next big thing.
But real estate value is hyperlocal. It happens at the intersection level. Dr. Ghamari points out that you can have one street in a so-called hot district that has 8 new towers launching at the same time.
Oh, that sounds like a nightmare.
It's a supply bomb. Imagine 3 years from now, all 8 of those towers hand over in the same quarter. Suddenly you have 3,000 landlords all trying to rent out identical one-bedroom apartments.
It's a race to the bottom. Rents are going to crash.
Of course, But two streets over literally a 5-minute walk. You might have a street that's fully developed. No empty plots, no construction noise, established shops.
Scarcity.
Scarcity. Same district, totally different investment outcome. The source advises you perform the weekday afternoon test.
I love a good field test. How do you do it?
You go to the site alone, no agent in your ear, go on a Tuesday at 2 p.m., and you just look, are the cranes actually moving? Or are they just statues? Look at the retail. Are the coffee shops open and serving people, or are they just boarded up with dusty coming soon stickers?
And the infrastructure.
Is the road actually paved? Is the metro station operational? Or is it just a dotted line on a map that says proposed future connection?
Proposed is the most expensive word in real estate.
It really is.
Yeah.
If you buy based on a proposed metro, you're buying an obligation. If you buy based on an existing road, you're buying an asset.
This brings us to the due diligence ritual. The source outlines 5 filters, and he says professional investors spend minutes on these to kill a deal, while amateurs spend hours looking at floor plans for a deal they should have ignored from the start.
I want to run through these because they're basically a checklist.
Let's do it. Filter 1, construction milestone verification. This is simple. Is the foundation done? If a project says it's 50% sold, but they haven't even dug a hole in the ground, you just walk away.
Or what if it's 60% built, but it's still at the launch price?
That's a red flag. Why hasn't it sold? Is the layout terrible? Is the view now blocked by another building? The market isn't stupid? If it's sitting on the shelf, there is a reason. Okay, filter 2, comparable ready stock. We touched on this, but it's worth repeating.
It's the ultimate sanity check. Can I buy a finished apartment next door for the same price? If the answer is yes, the off-plan premium is not justified, the case just collapses.
Filter 3, supply corridor mapping.
Draw a 2-kilometer circle around the site on a map. Count every single unit coming online in the next 24 months. If the supply is 5,000 units and the historical absorption, the number of people actually moving in, is only 1,000.
You have a glut.
You have a glut. You are betting on a population explosion that just hasn't happened yet.
Filter 4, rental demand validation.
Do not trust the flyer that says 8% ROI. That is a fantasy number. Find a property manager who works in that area. Ask them, what is the actual rent being achieved this month? And how long does it take to find a tenant? If they say it takes 3 months to fill a unit, that vacancy cost just destroys your yield.
And finally, filter 5, exit optionality.
Who is the next buyer? This is the question that kills the flip strategy. If you need to sell before completion, who are you selling to? If the only other buyers are also speculators, you are in a bubble. The moment sentiment turns, they all vanish.
You need a natural buyer.
You need an end user, someone who actually wants to live there. They provide the floor price in the market. Speculators just provide the volatility. If the project doesn't appeal to a family or a professional who wants to live in it, do not buy it.
This really dismantles that idea that new is always better. We have this obsession with the shiny new thing. But the source suggests that new projects only outperform if they're genuinely different.
Correct. If it's just incremental supply, just another glass box in a sea of glass boxes, it's not going to outperform. In fact, in stable markets, older, well-maintained buildings in prime spots often have better risk-adjusted returns. The entry price is lower, and the location is already proven.
So we've done the ritual, we've filtered the deal. Now how do we actually make the decision? Dr. Ghamari proposes a scoring matrix. I love a good matrix, but the weightings here really surprised me.
It's designed to take the emotion out of it. He assigns specific weights to 5 categories. Developer reliability gets 30%. That's the heavy weight.
Okay.
Location fundamentals gets 25%. Pricing logic, 20%. Exit liquidity, 15%. And here's the surprise. Contract terms gets only 10%.
That feels wrong. Shouldn't the contract be everything? I mean, that's my legal protection.
In theory, yes.
Yeah.
But in practice, no. The logic is a bit cynical, but it's accurate. A great contract with a bad developer is completely useless. If the developer goes bankrupt or flees the country or just refuses to build, that piece of paper is not going to magically construct your apartment.
You can't sue a building into existence.
Exactly. But a bad contract with a good developer
Usually works out.
It usually works out. Because a top-tier developer cares about their reputation. They have a 20-year pipeline. They won't blow up their brand over a dispute with one buyer. They'll deliver. So reliability outweighs the legalese.
That is a crucial insight. So what's the walkaway number on this matrix?
If the total score is under 70%, you walk away. Don't even try to convince yourself, just leave. If it's 70 to 80%, you negotiate hard. Only if it scores above 80% should you proceed. and even then, with caution.
It sounds like this entire approach is just about discipline. It's about fighting that FOMO.
That is the core of it, the discipline of patience. The source argues that the best positions are often taken mid-cycle.
Meaning, not at the launch party with the DJ and the confetti cannon.
Exactly. Let the frenzy pass, wait 6 months, wait for reality to set in. Maybe a few speculators over-leveraged themselves, and now they need to get out. That is when you find the value. The quote from the text everyone should remember is this: "The market will always offer projects. It will not always offer value."
That needs to be on a billboard.
It does.
So let's wrap this up with a final reality check for our listener. If you're holding that brochure right now, thinking about signing that check, what are the absolute golden rules you cannot break?
Okay, 3 non-negotiables. Rule number 1, liquidity. Never commit more capital than you can afford to have illiquid for 36 months. Assume you cannot sell. Assume the money is gone for 3 years. Can you still sleep at night? If not, don't do it.
Rule number 2.
Downside modeling. Never assume appreciation. Everyone pulls out Excel and calculates how rich they'll be if prices go up 20%. Don't do that. Model what happens if prices drop 10%. Model what happens if rents drop 15%. If the investment goes underwater in that scenario, it's too risky for you.
And the third rule.
Seek the rare intersection. You are looking for the trifecta: a credible developer, genuine end-user demand, and rational pricing. It is very, very hard to find all 3. It's rare, but the market rewards that scarcity. If you don't have all 3, you are not investing. You're just hoping.
There is a final provocative thought in the source material that I think just sums this all up perfectly. It's a question every investor should look in the mirror and ask themselves.
If you wouldn't be willing to hold and rent this property, if sale conditions deteriorate, are you actually investing?
Or are you just gambling?
Or are you just hoping to pass the hot potato to a greater fool? If the idea of being a landlord for this specific unit terrifies you, then you have no business buying it off plan.
That's the ultimate litmus test. You have to be okay with the worst case scenario.
You do. Because in real estate, the worst case happens a lot more often than the brochure suggests.
Well, this has been a massive reality check. I think we've successfully dismantled the billboard. Dr. Ghamari's work is a reminder that in a world of hype, the boring details, the track records, the absorption rates, the supply corridors, that's where the money is actually made or lost.
Absolutely. It puts the power back in the hands of the buyer, as long as they're willing to do the work.
And that's what we're here for, to make you do the work. Thank you so much for listening to this deep dive. Go walk those intersections, count those cranes, and we will see you next time.